Okay, awesome. Joe Kaiser, welcome to Deep Tech. I've been really looking forward to this conversation. You're one of the few investors who's lived across institutional finance at Blackstone, operated inside a high growth company through the public markets at Vivint Solar, and now you lead Mercato Partners. That perspective gives you a very different lens on risk, capital, and value creation. So today, I want to focus on three things: what's broken in growth equity, why geography actually matters more than people think, and then how to underwrite real value creation instead of a momentum. So let's first start with your path. Looking back across your career, what are some of walk us through your story and then tell us what sort of the learnings were as you went from one to another opportunity.
Well, Tom, I'm honored to spend time with you, of course, today. And, my background, I think actually it'll all tie together across your 3 points. My background, I'm from a small town in Missouri, Jefferson City, went to undergrad in St. Louis and, as you know, grad school in Chicago.
Mm-hmm.
And I've spent half of my career on what I would consider operating roles, from being a co-founder of a business to leading a turnaround of a manufacturing business to ultimately, as you mentioned, joining Vivint Solar in its earliest stages and helping them scale from zero in revenue to 200 million in revenue in just a couple of years and go public and then ultimately sell for 5 billion. All of those experience, I think, came together to allow me to be a growth investor. And it's interesting, and we'll dive into this, but I think that blend of finance and operating experience, that blend is really important when you put the growth lens on.
Interesting. What's the kind of through line that you didn't fully appreciate early on, but you see very clearly right now?
I think the through line is this combination of trying to estimate where the puck is going and then using my skills to create value with entrepreneurs, and having this notion of, if I'm ever the smartest person in the room, Tom, we're all in trouble. So bringing a very humble, hungry perspective, and really just that Midwestern, and as we say in Missouri, it's show me. So I don't need to. I just want to. Sorry, I'm messing this up, but in Missouri we say show me, and that's kind of the mindset I bring. Like, I just want to put shoulder to wheel, and I play for the name on the front of the jersey, not the back. And fortunately, I think the founders and CEOs that I get to work with day in and day out appreciate that mindset.
I love it. Yeah, I mean, I'm an engineer, so the saying that I always tell some of the folks that I work with is anytime they say something, I'm like, show me the data to support that, right? And if the data doesn't support that, we're going to go down the path of leadership's opinion or my opinion on the matter, right? So
totally.
So it's
and I think I love that. I mean, that is what I love about the growth stage versus venture, is there's something to show, right? I mean,
yes,
real financials. There's a real P&L. You can really dig into unit economics, and you can talk to actual customers about whether or not the company and its underlying products and technology are delivering on the value proposition.
Absolutely. No, I certainly, we invest in early stage and growth, and the growth stuff is definitely, I love it. It's absolutely amazing. And you could tell you're dealing with real businesses, right? Real products, real businesses. And how do you know it's a real product? People are paying for it, right?
Exactly.
Very important. Very important. So just kind of backing up, looking back at your career, I know you spent some time at Blackstone, private equity, and all of that. Tell us a little bit about what that taught you in relation to capital structure and what venture investors kind of, how they evaluate the ecosystem.
Yeah, I would say I learned a couple things at Blackstone. Even the scale of the firm when I joined, call it 2010, was already a massive, the largest buyout firm in the world, and still entrepreneurial at its core. So that to me was maybe the biggest takeaway, is regardless of size of the business and institution, that entrepreneurship is in your DNA or it's not. And so I really took that away. And then the quest for excellence is the other thing I would say is ingrained in the culture and work at Blackstone. not in a overbearing way, but just people at Blackstone are just so talented and they bring their A game to work every single day. And that's, like probably like you growing up, Tom, where you could slough off and then do the cram session the night before your test. Like you can't work like that at Blackstone.
Yeah.
So I learned that lesson as well. The flip side is I learned, I worked with some brilliant people and learned about financial engineering, but I also learned it's not for me. I want to be next to the founders where I can see the impact of our decisions as opposed to these multi-billion dollar size businesses where, turning the screws don't really make much of an impact.
How did that sort of influence you now that you're more on, your growth equity is sort of more towards the venture side relative to where you were at Blackstone? How does Blackstone experience help you think about risk?
Yeah, I think it all comes down to quantitative rigor. That was the key phrase that I took away from my time at, the time at Blackstone. It's all comes down to quantitative rigor. The stories are nice, but do the numbers bear out whatever the story is? And so like the focus on unit economics, I was talking to a friend of mine recently who's in buyout, and we were comparing and contrasting growth equity versus buyout, but the businesses at their core are fundamentally the same. And in that, the unit economic footprint should look the same. And then it's just one still has a lot of growth. So they're investing in that growth. And that is actually when you take the full P&L, that might be why EBITDA is negative and cash flow is negative. And one is maybe more mature and is now in more of a cash flow harvest mode, but they're at a unit economic level, at a margin level, they should feel fairly similar.
Very cool. Very cool. And then, so shifting to your kind of operating experience at Vivint Solar. So you were raising large scale project finance there, and that sounds exciting. It's quite a change. How did that experience fundamentally change your view on risk and just your investment style?
Yeah. So at Vivint Solar, the business there, we were the first mover in residential solar.
Okay.
And one of the key components of making that come to life was a federal tax credit program. And the interesting thing at the time, at least, the companies that generated the tax credit could not sell the tax credit. That's changed since I was at Vivint Solar, but the financial engineering to monetize that tax credit when you're a money losing business, it took some effort. So, and that's what our team did, was we raised several $1 billion of project finance that was ITC tax credit based. But what it taught me, because what our counterparties in these structures asked us, it was blind pool, just like our business, right? It was blind pool risk that these investors were investing into. Was tell me what that solar system is going to look like on the roof, given a little bit of variance, right? And I think that also plays out in our business, where our limited partners come in and say, I have no idea. I can't look through the crystal ball and know what you're going to invest in over the next 10 years, but give me confidence that you're going to stay inside of this lane or this profile that you're investing in, and I'm going to hit the return that you're proposing. So I think that what we got financial institutions comfortable with at Vivint Solar just taught me, like, what is the expectation that limited partners are going to have at Mercato?
Awesome. Very cool. That's a really interesting insight. If you had to point to one piece of scar tissue that you're grateful for today, what would that be?
Oh, so many. Limiting my mistakes to one. Just ask my wife. I probably made 5 today that scar tissue will teach me a lesson.
It's a good attitude to have. Yeah, it's a good question.
I think it goes back to that cliche about you learn more from your mistakes than your victories.
Yeah.
And I think that holds true here. And as I look back across my career, what is the big mistake? What is the common mistake that I've tried to improve? And it's just direct communication. Does that matter that the light flipped off?
Not at all. I think it added a little spice to the podcast.
My mistake. Take this from the
Ball.
timer off.
Looks great.
No, but I think all too often, particularly when you move away from the coast, I have found that founders and investors don't communicate respectfully but directly, and I think that is a key in business, is respectful, direct communication.
I love it. That's awesome. That's very, culturally it reigns true in our culture at Natera Ventures. I mean, we have a German leader, a Japanese conglomerate. And so we try to, maintain a discipline of being very, certainly transparent, but also direct about feedback. I think that's how you learn. So that's really, I think it's great to be that way in deal making as well. Right.
Absolutely. Absolutely.
So you doing some research on you and Mercato, you're often described as a very founder aligned, hands-on partner, which is so awesome, right? I think that the world needs more investors like this. But so where's the line between being genuinely helpful and becoming a distraction for the entrepreneur?
Oh, great question, Tom. I think so. One, I would start with, our approach is investing in what I would consider the heartland of the country. And I bring that up because the types of founders and CEOs that we work with are different than founders and CEOs in the Bay or New York for a couple of reasons. One is often the founders we work with are first-time founders. But second, again, going back to this cultural means of communication, how those founders communicate and want to be communicated with is different than if you're on the coast. And so we orient everything we do at Mercato to solve for those two things, like the cultural fit with that founder CEO, as well as how to help that first-time founder see around the proverbial next corner in a way, the way that you just said it, like that it's helpful. We take a head in, hands out approach. So we're never overbearing. It's someone else's job to execute and operate, but we've seen businesses scale quite a bit, and we want to be helpful where we can be. So I would say, Tom, I think a lot of times, there's so many people that carry a venture capital card or growth equity business card, and it's pretend. So it's a combination of cheerleading, rah-rah, and hey, I've got these 3 sound bites that I tell every founder, but I have no substance beyond that. And I think this is where being an operator comes in. So again, I go back to our saying of head in, hands out. I do not want a CEO to ever feel like I have reached into the org in an inappropriate way. My conversations always stop at the CEO unless the CEO asks me to go deeper in the org.
Interesting.
Always. And then having that experience as an operator of knowing when I feel like I have real conviction and experience around something that I would say or add to the conversation with the CEO versus when I've just heard something on a podcast and I have no substance behind it, I'm probably going to keep that to myself.
Very cool. So you kind of addressed this a bit, but what are sort of the key moments where a founder should actually want the investor deeply involved, right? What are those instances?
One of my partners here has a saying: management owns the P&L, the board owns the balance sheet. So I think that is when balance sheet considerations are in play. I think that is when the CEO definitely should have his or her board members deeply engaged. And then I think, that part of the benefit of a great board for a CEO is having experience and having people that fill blind spots in the business. And so assuming that board member or that CEO has board members, either an independent board member seats or otherwise, that fill those blind spots, just knowing that you've done that intentionally and then reaching out to that board member about, hey, I'm seeing this. What do you think? How would you react or how do you perceive this issue that I'm working through, and getting that feedback is part of why you have a board.
That's awesome. I was just gonna unpack something you said earlier. You said a lot of the firms, and I want to move to kind of Mercado's geographic thesis here. But you made the comment that a lot of your CEOs are first time founders, or your founders are first time founders.
Right.
Any idea why that? Why is that? Is it just because of the geography that you're targeting? You don't have as many repeat founders, or what's the story there?
In some ways, it is, Tom. It as you know, like the the distribution of brilliance in the United States is pretty even. So it's not like the Bay Area or New York or the engineers or scientists, et cetera, are any smarter or less intelligent or capable than their counterparts in the middle part of the country. But the difference is someone that graduates from Stanford or Berkeley or Columbia, they might end up in tech or start their careers with a startup. And so they just quickly learn how that operating model, how to work in an unstructured environment, versus a lot of the time that the kids that are graduating with STEM degrees in the heartland of the country, just as talented and capable, but they probably, the data suggests they end up with Fortune 500s. And so they're working in a very structured environment, and a lot of times not in tech. And so but these big companies do incubate talent and spark ideas. But those now would-be founders now have to figure out, okay, I've never in my life thought about a startup. I've never worked in an unstructured environment. What do I do? And so that's the thing at Mercado. So we're a growth equity investor, not an early stage investor. But I think those of us that spend all of our time in the heartland of the country, that is the biggest, one of the biggest problems that we help our companies and our portfolio companies solve, is how do we help these brilliant founders and early employees produce their best work when they're in an unstructured environment for the first time. Interesting.
That's very interesting. Kind of going beyond the headline of, you don't have to, you can start startups in the heartland, to borrow your term, right? Beyond that headline, what are some of the non-obvious mechanisms that make the geography give you an investment advantage in the region, in the heartland regions?
That's a good question. Tom, I would say the other thing that is consistent, regardless of geography, regardless if we're talking about the Bay or New York or Chicago, is there are foundational industries that are training founders and training these first-time employees. So in the Bay, it's tech, right? It is. Yeah. There's a reason why AI is so prominent and prevalent in the Bay versus in other parts of the country. So when we move to the interior of the country, it's industries like financial services and healthcare, and now we're talking a lot about energy and electricity. And so that's why those industries are spawning founders in the middle part of the country, is because they've grown up from a career standpoint in those spaces. And so aligning with thesis and networks to support startups in those spaces is maybe a double click.
Very interesting. So do a lot of the tech companies in the heartland, are they inevitably influenced by these kind of like Fortune 500s in the middle of the country, right? So are all these startups kind of thematically influenced by these groups, and is that what you're kind of seeing, or do you see a lot of deviation from that?
I'm cautious to say always and ever, but yes, I think a vast preponderance of startups are, the idea is spun out of an industry that those founders have grown up in.
Very cool. Very cool. So what's the real kind of advantage in the kind of the non-coastal, the heartland, right? Is it valuation, access to talent, customer proximity, capital efficiency? Is there something else other than those things that you see being beneficial?
It's a great question, Tom. I think a lot of times that when I talk to my cohort that focus on the San Francisco or New York, it's binary. And by that, I mean, founders have this binary mentality. I want an exit of multi-billion dollars, or I'm going to flame out trying to get there. And it doesn't really matter if you're talking about a seed stage company or a Series F stage company. It's still that same mentality of I'm going to make a $10 billion outcome here. And I think not only do founders have that mentality, but a lot of the employees have that same mentality about like, I'm playing for option value here, my equity option value here. And if for some reason it looks like it's not going to be worthwhile, I'm going to take my equity, my time, and invest it somewhere else. You move to the middle part of the country and that gets turned upside down. Like a lot of the times I'm actually having to pull founders into investing faster in their businesses. Obviously when things are working and they should, versus the opposite in the base. So does that limit your $10 billion outcomes in Chicago versus San Francisco? Absolutely. But it's just a different mindset.
Interesting. No, it's really interesting. What do you think coastal investors systematically misunderstand about building companies in these kind of undercapitalized regions?
One, that they can be built.
Fair enough.
I remember when I started, and that was when blitzscaling came out. The book Blitzscaling came out, and it was all about how successful startups can only be built in the Bay. And then recently, I'm a huge Bill Gurley fan, but Bill said startups can be built anywhere, but they can only scale in the Bay. And I think both points are BS. But it takes as an investor, it takes a different playbook when you're working with founders in the middle part of the country versus on the coast. And I will say too, thankfully we have more of a hybrid work environment world now. So you can have talent, distributed around the country. And I think, companies that are founded in the middle part of the country are able to take advantage of recruiting talent in other parts of the country and the world where it's not domestic.
Interesting. Are you seeing, so the edge appears to be real here in the heartland. Why hasn't it been fully arbitraged away by now? What's the dynamic there?
I think it's starting to be. I think this notion of like when I started at Mercato a decade ago, there was real arbitrage. Even take Chicago versus San Francisco or New York, and I think that has gone away by and large. The other, because I think before 10 years ago, a lot of founders didn't understand that weren't around the startup environment, didn't understand how to attract venture capital and how to engage with venture capitalists. And now that's not true because of podcasts and because of social media and the ability for founders to reach out to other founders and get education about how to build and fund their businesses. I think that wall has sort of melted down. But again, I go back to this cultural alignment. The boardroom is actually the core of a company's culture, not tangent to it. And so I think smart founders want people that are additive, not disruptive to their boardroom and their culture.
Very cool. Very cool. That's awesome. Yeah, I'm just kind of moving on here. I was doing a little bit of research before our session today, and you've talked openly about implementing a more deliberate firm-wide approach in 2022. So just wanted to ask you, like, what caused that? What changes happened internally at Mercato that sort of inspired that approach?
Well, I think we're deploying our fourth fund today, and I think as we became more institutional and the dollars we managed became greater, and working with more and more founders, I think the answer was to become more focused, not less. We started doing NPS surveys with our founders and really wanted to understand two questions. Are we your first call? When something good or bad happens, are we your first call? And the second is, if we're not, why aren't we your first call? And how do we get better? And the good news was most of our CEOs were saying, yes, you are our first call. But by and large, the feedback we got was, hey, look, to be even better, what we'd really like is Rolodex expansion and leverage. And so that is, starting back in that 2021, 2022 timeframe, Tom, that's where we put all of our value add wood behind the arrow. So how do we help these companies that can't go across the street to the coffee shop and talk to 10 different acquirers or investors to lead their next round. How do we help them communicate more effectively and engage ecosystem partners in a much better way?
That's awesome. Was there anything that you stopped doing at that time in 22 and on?
Yeah, yes. So Mercato historically, like the firm was founded with the premise of bringing value add to founders at the point where you're starting to inflect and build process into your business. And what we found in those early days, we would have a sales expert and a marketing expert and a human capital expert. And with, they would be grizzled veterans with 25 or 35 years of experience in their specialty. And we would send them in to work with their counterpart in these companies. And Tom, ultimately what our CEOs were telling us is, hey, if I have a C- player and a seat, I don't want you to be a crutch for that C- player. I want you to tell me I have a C- player, and I want you to help me find someone that's an A+ player. And so what we did was just shift our value add approach to be more, again, respectful, but direct in communicating, not trying to be a crutch for a below average player on a team, but tell the CEO, hey, this is your problem and let's work together to fix it, and then help them communicate better and advertise their business better with their ecosystem to scale their business.
Very cool. What did you start doing that felt, slightly uncomfortable, right? Was there any change that you felt was either uncomfortable for you or the team?
Well, the one thing, Tom, I would say is it really, we expanded our footprint from a geographic investing standpoint. So when I joined 10 years ago, we were really myopically focused on the Rockies. And then we expanded that to Southern California, and then expanded again to Texas and connecting states, and then expanded into the Midwest, and now even into the southeastern part of the United States. So just given that expansion, it meant that we had to work a little bit more and pods than we have historically. So that was the first thing. The second was we really shifted to this approach of being community-based intelligence. So being much more proactive and intentional about sharing everything each of us is researching and learning so that we can be more efficient when one of us finds an incredible company that we want to back. It's akin to, Excel's prepared mind, but with our own version.
That's awesome. That's awesome. Is there a KPI that you track that ensures that the strategy is real, not performative? I know you mentioned NPS score, which is a really unique KPI, I think, for a VC firm. I love that. Anything else that you track to make sure that it's a real success?
Well, Tom, any LP of mine that's listening would say, you better say DPI. So I start by saying DPI and TVPI.
Fair enough.
But that's a great question. Not explicitly, the thing that we're very focused on is, the sourcing funnel, sourcing, picking, and winning.
Yes.
I think this is where, going back to the differences in focus in geography, I think that if you're in a high volume geography, sourcing is pretty important. Being first to deliver a term sheet is really important. When you're in the middle part of the country, because the volume declines significantly, I have the ability. It's like here in Utah, there's a lot of people that enjoy fly fishing, and so you can see the fish you want to catch. And I think that is sort of like sourcing in our geographies. We can see these companies well before their growth stage, and so winning now becomes the pre-ultimate metric that has to be true, Tom. Like, if we have invested years in building a relationship with the founder and they fit our thesis and we're very bullish about the runway in front of them, we have to win, because it's not like we're going to see 5 more in the next month. We have to win that deal.
Amazing. That's awesome. You've mentioned publicly that the traditional growth equity model is broken. If you had to define the failure mode in one sentence, what is it?
Overcapitalization.
Okay. What do you mean by overcapitalization?
I think the problem in this industry is firms have focused more on AUM and less on returns. So
Interesting.
that's the first problem. And then the byproducts of that are firms now are forced to write bigger checks, higher valuations, and really don't add value to the portfolio companies that they're investing in. And so
Interesting.
all of those have multiplying effects that
Mhm.
I think when you write a check that's too big at a valuation that's too large, now you're
Mhm.
forcing that CEO to shift risk in
Mhm.
terms of now I've got to, if in my heart of hearts, I thought my business was worth 150 million and you just gave me, and I only needed 20 million, but you just gave me 50 million and you gave me a $350 million valuation. That's even more pronounced in AI. But now these founders, they're forced, you think about 5Xing or 10Xing from there, they're forced to swing for the fences. So, and take on a lot of risk, but hey, they've raised this big round. So what's an extra 500K a month to burn? And so I just think our model, the broader growth equity model, has caused bad behavior.
Interesting. What's the most common spreadsheet lie that you see in growth investing today?
That the spreadsheet's right. That's what I think the biggest lie is. No,
Okay.
I think
You mean the P&L, the growth projection?
exactly,
Yeah.
exactly. I think
Gotcha. Yeah.
all too often, if you're not an operator, if you don't bring operating experience to the conversation, and this company is at 5 or 10 million in ARR, and they're forecasting to go from 10 to 150 in 18 months. I mean, obviously, as an operator, you would say not a chance. But even still, like I just think the belief that that hey, the Excel says it's possible, like that's a major trap. So I think you have to start with an operating lens of understanding what is possible and what will break before you get into Excel.
Interesting. So kind of reflecting on the growth equity model being broken, if the old model is broken, what replaces it in the future?
That's another great question. I think there's a couple of things that are occurring in our industry, and there's a KPI that's going to come out of it. So I think by and large, because AI is reducing the barriers to starting a company and engaging with customers, and the capital required to build companies to say 10 million in ARR is coming down dramatically. I think that seed A, B stage is going to get compressed, and the capital required at that combined seed A, B stage is much less than it had been for the past 10 years. So that's, and at least in a software, non-hardware, non-physical AI world, I think that's what's going to happen. And then as a consequence, I think the KPI that matters a lot ends up being AUM over FTE.
Oh, interesting.
Because so much research, so much thesis testing, so much sourcing work can be done with AI.
Yeah.
The team sizes, I think, at venture firms shrink over time. In physical AI, I think it's exactly the opposite. Because so much capital is required to really get that product dialed in, get the certifications and permits, et cetera, that are required before you can sell it. And then obviously a sales motion, piloting and getting past that to valley of death from pilots to commercial sized POs and into production environments. I think that the physical AI world probably requires more capital early.
Yeah. Very interesting. Let's shift into, speaking of AI, let's shift into deep tech for a moment. So
Please.
given your capital markets background, how do you diligence companies where the technical roadmap or the physics itself is the risk factor?
That's a great question. So the role back in my Vivint Solar days, the role that may have been more important than any on our capital markets team was the person that engaged with the independent engineers. And that role was an engineer. It was technical. It was explaining like everything from the OD of a wire we were going to use to how we were going to ensure that that we were going to get electrical permits approved every time, regardless of municipality. And so I think that becomes really, really important in the physical AI world is from a value add standpoint is how do we as investors help ensure that the companies that we're investing in at the growth stage, at the companies that we're investing really understand and have all the processes and people in place to streamline the broad scale commercialization of their technologies and products. I think that is the number one value add that we as investors can bring.
Awesome. What's the evidence that you need to believe the technical team at a company?
Again, so the early stage folks, I would have a much different answer like that.
Yeah.
I'm not a physicist, so that's a whole different can of worms. But at my stage, I think it is all about, one, goes back to unit economics. Do we have proof of the unit economics and are they sustainable? Two, do you have everything necessary to commercialize your product in the market that you're telling me, the investor, that's where you're going? Like, do you have customers? Is it happening? And you just need to do a lot more of that. Is that true? I think those 2 points, Tom, are the things that I would really, really focus on.
Awesome. So you guys, so you're looking for evidence that this is being purchased and that product can be deployed, right? I mean, that's really that's a fantastic way of looking at it, right? Obviously, it's a different ballgame on the early stage side, but it's ultimately the only metric that matters at the end of the day. How do you? So let's say you have a company where their core product, you have evidence of that, right? But there's a new product that's being rolled out that is a critical part of the growth story. How do you distinguish a credible milestone plan from this new product being a science project?
That is I keep saying it, that's another great question. That is where I think another area that's really hard for growth equity. As a growth equity investor, we just want repeatability. We want our dollars to be used as gasoline for the engine. Like what's working today, let's just multiply that from a risk lens. That's what we're trying to do. And so when the growth story and our return profile, what's required is this thing that's never been done to work. It moves backwards into venture as opposed to being in growth. And so I think those are the really tricky ones to underwrite where, hey, it's not a $25 million early stage investment, from a valuation standpoint, because this legacy business is working, but it's not, you can't value this product that hasn't really been market tested as if it were. And so those are the tricky ones. That's definitely where you fall into the more art than science. Unfortunately, at Mercato, we've had several of those work out really well. Where I would focus my diligence is, what does the customer say? Like, has this thing been beta tested even? And what does that customer say?
Awesome. So in deep tech, founders often argue inevitably the world will need this, right? How do you translate inevitability into a financing path that doesn't kill the company?
Yeah. So I'll tell you. So as you know, Tom, I invested in a company called Taurus that's on the storage and grid connectivity side. Similar scenario when we wrote our first check into Taurus. So product was complete. That they had all the permits and certifications required, but they wanted to transition from more of a residential orientation to commercial and industrial orientation. And so I'm not that technical. So I hired an independent engineer to listen, look at the tech, double check all the certifications, permits to make sure that we were green lights from a go-to-market standpoint. And then I talked to a handful of executives at utilities and said, this is what we know. This is what the company has. Would you buy this? And universally, the answer was, yes, I'll take some of that, please. And so that gave us a lot of confidence that it is now just execution. Technology risk has been solved, and now it's just execution that has to occur, and we can underwrite that.
Awesome. So let's talk a little bit about AI. You mentioned AI earlier in the talk. So you've spoken about AI strategy and valuations. What's your litmus test for durable AI advantages versus a feature?
Oh, that's again, Tom, another great question. I tell you, this is why I am so bullish as an investor about physical AI, or at least when there is hardware coupled with code, is that I think that that is the delivery mechanism that creates a moat. Mercado's founder, Greg, he has this great saying that influences me a lot, and that is, when oil has been struck, you better put a gas station on every corner. And I think that's the advantage, or that's the moat, the persistent moat that hardware can bring to the table. And so we're pretty excited about things like edge compute and hardware delivered edge compute. And obviously, we're really, really excited about the electrification and energy transformation that's happening in the country.
Yeah, we're very aligned with that as well. Where do you think the market is still mispricing risk in AI?
This goes to, I have to answer with, I don't understand how some of these AI software only companies are being valued. I'm sure the people that are writing the term sheets and signing the checks, it makes perfect sense. But like, when you're valuing a seed stage company that has very little customer traction at hundreds of millions of dollars, I just don't understand how you can underwrite that, other than I have a huge fund that I have to put to work.
Sure.
That's one. But to my benefit, I think we're assets that are undervalued. I don't think traditional venture investors can take that traditional software SaaS mindset and translate that to physical AI and what is it? How do I think about a 20-year power purchase agreement? Like, what does that mean? They've never, like, you actually have to do a DCF to figure out the value.
Fair enough. What's your quick thoughts on agentic AI? There's become a very crowded space. I've heard from several VCs it's hard to invest in. What's your kind of thought process on it?
I agree when it's a horizontal or consumer application. I think where it gets really sexy is when there's vertical application. So not to talk my own book, but another company I invested in called Artisight, which is using its hardware, GPU-based hardware, to now deliver a nurse co-pilot into the patient room. That's agentic and doing some really cool stuff that is producing value, producing a real tangible ROI for hospitals. So I think ROI, if there's ROI, it makes it real. In a vertical solution, it makes it really hard to rip and replace.
Awesome. Well, we're now in the lightning round. We'll go through some questions very quickly. So let's put you under some fire here. So what's one metric that you trust more than ARR?
Gross retention.
Okay.
Gross retention ratio.
What tell us why a little bit.
That is the customer voice speaking to you. ARR can be turned off, particularly if it's full of pilots and first time customers. Gross retention is the opposite end of the spectrum.
Awesome. Okay, so what's a founder behavior you'd bet on, even if the numbers are not as sexy, so to speak?
Can they simplify the story for all audiences? So can they explain how they're going to change the world to an investor, to a customer, and to their employees?
Awesome. What's an underloved U.S. market right now?
All of the heartland.
Yeah, right? I set that up. Yeah.
The middle part of the country for sure. And I'll just, because it's the biggest city, I'm going with Chicago.
Awesome. Absolutely. Go Chicago. What's one thing that VCs should stop saying to founders?
Yes.
Enough said. Okay. Well, this is awesome. Kind of wrapping up our session today. What's one kind of piece of advice to a founder building an undercapitalized geography? So, sorry, let me repeat that. Sorry, we have to edit that out.
Good, man.
Joe, if you could give one piece of advice to a founder building in an undercapitalized geography who wants to win without moving to the coast, what's the 60-second playbook?
I think the quick takeaway is surround yourself with people that have seen it and done it before. The message that I tell all of my founders, and I try never to say, blanket, here's the answer, but the answer that I often tell founders, don't let people learn how to do something on your dime. Hire people that have already done it and just need to adapt the playbook to your business.
Awesome. That's great. This is great. Joe, this has been fantastic.
My pleasure. Time is a good phone.
Absolutely. So as we close out the session, where should people kind of follow your work and Mercato's work? Where can people find you, I should say?
Well, my email is jkaiser@mercatopartners.com. I know that's pretty old school. I'm pretty active on LinkedIn and social media, so happy to connect there as well.
Amazing. Joe, this was a great conversation. Thanks for joining me on Deep Tech.
Thank you, Tom.